The one thing that I want to stress here is the opportunity. Right now, we are in a place in the market that is so wildly different. Getting started or even scaling a business, you have tools that the REITs had. I'm shocked about how we think the business should operate, but then we don't participate as customers. No, I think we should do this. We don't need a website. And then you go and actively consume differently than you run your business.
Normal is going to be the continued adoption of technology and implementation of it in the self-storage facility and the operations of the self-storage facility. That is the customer expectation of all of the businesses that they interact with.
All right, ladies and gentlemen, welcome to the stage, AJ, Lance, and Travis!
Welcome, everybody. We are so excited. It's been a great event so far. Who here, I'd like to know who's listened to the podcast the longest. So let's start. Everybody that's listened to it for at least a year. All right, there we go. 2 years. Okay?
That's
right.
Mom.
It's my mom. It's my mom. It is. It's my mom. 3 years. All right. 4 years. There we go. 5 years. All right. Now let's see. 6 years. That's right. It wasn't in existence 6 years ago, so my mom was the only one listening. So this actually was true. I was wondering if I was going to get a bunch of hands at 6 years and have to be like, I wasn't doing it 6 years ago. Well, when we started the podcast, it was literally just like a laptop and I plugged in a mic, and that was it. It was really high tech. It was a very bad mic. It was not a good mic. We were talking about this yesterday, how funny it is to actually go back and look and how ridiculous it seems now. But when I started the podcast, it was originally because I'd started a blog, like a blog. I'm not a blogger, I'm not a writer, and so that's why no one knows that it existed, because that ended very quickly. But I needed something that I could do while in my wheelchair, and so that's kind of what I started doing. I was doing kind of some video stuff, but I was gonna write, and I was just not a very good writer. That was not my thing. But I didn't mind talking to no one for some reason in a mic. I don't know what that says about me. I'm sure I'll talk to a therapist about that later, but for hours into a mic talking to nobody. It's been an incredible journey because so many people have, for years now, been listening, and so much has changed over the last, 7, because I started the blog and everything was kind of started about 7 years ago, and talking about storage. And when I first got into storage, I remember kind of going to some events, and some of the first people that I met were Travis and Lance. So go to the conventions, they were not anything like they are today. Maybe the only reason you guys were some of the first people I met because you were some of the only people there. So that actually makes sense.
I think it was the YLG where I first met you.
Yeah. Yes.
I don't think they let me in that one.
You were not allowed in.
Not allowed. YLG. Not invited. They had to pay us to get you here. So it's changed a lot, and information in this industry, how this industry is viewed, has changed wildly. Everything from risk to its purpose, and that it's not going away. There was originally, and this is the early 2000s, and there's been people in this industry since the 70s, but even then, there was this idea that this was a really risky asset class, and there was even a lot of people who were talking like it's a fad, like it's literally going to go away. And those that weren't in it, I think, were very confused by it. They didn't understand those larger trends at work, like the mobility tied to regulation and high cost of real estate, and what it costs somebody to rent versus a storage unit versus adding on to their home, and how HOAs would change the world, and how storage became a ever more standardized part of our life when you live in a world that has high regulation over housing, over how you use your land, what you can do. We have a mobile population, and then the internet's effect on really decentralizing the workforce as well as companies, and how that sped up momentum and movement within the world. And those that were in the industry, they knew, right? All right, this isn't going anywhere. And those conversations that we were having a long time ago when I was in search for people getting in the industry, like we need a community, need others to learn from, to grow. And Travis and Lance were those people that I met that were like, no, hey, let's talk about this industry. Let's do more. Let's start an association. Let's get it, because the future is going to be very, very different. And what's happening with technology, the internet, and how we're a fragmented industry. At the time, it was like 93-4% individual mom and pops. You know, there were certain individuals in the industry that were having higher level conversations, that were seeing what was happening and the change, and saying not only will it not remain like this, it is going to change wildly. In fact, it can get very hyper competitive, and the competitiveness of this industry will come at huge gains to those that could use scale, technology. People were moving at how they found us. And that was literally only a few people that could even see that or understand that. This was at a time, you have to remember that, you know, we were talking and trying to convince people that a website was not only meaningful, it was important.
Online rentals were insane.
Yeah, that was like, yeah.
Easy.
I mean, no way. Like, how do you even do that?
Have to stare them in the eyes and look deeply into their eyes and determine if they're a good person who can pay me.
That's literally like what they thought. We're not kidding. There's a total waste. Meanwhile, they were paying $13,000 a year on Yellow Pages. And that was kind of the state of the industry. So for me,
500,000 is what I was paying on Yellow Pages.
that makes sense. Yeah, you would. He still does. And, you know, when we looked at that, it was weird for me leaving one industry, going into another, where the industry that I was in was, I don't want to say more advanced, but it changed quicker. People weren't riding on their laurels. It was hyper competitive, and people didn't have the choice to not do anything. So in that, there was this just vacancy of thought and even acceptance, or that they needed to change. And so it's really cool for me to be up here with both Travis and Lance, because when we were out searching, me and my dad, to find these communities, in our industry prior, we had been a part of an association that was a part of an industry that had gathered together to help individual brokerage firms and operators. It was an association that my dad helped get started and build up. And that was just, it was like, for us, it was, of course, right? And that's what these guys were talking about. And how together we are stronger. And how, in fact, this isn't just helpful, it is necessity because of what's coming. And today, I want to have some of those discussions again. Where's the industry going? How's it changing? How can we stay competitive? With all the changes from interest rate to the population, they're accepting us. We have more users of storage, but obviously slowed down due to interest rates. During this period of time, we're in a pause. We have all these firms that are gone, that were just pouring in. And the money stopped being not only easy, it stopped being thrown at you in the face and just slapping you. And other people, they're gone, they're left. But we're still here, same conversations we all had. We know it's obviously going to be great again. And they have deep knowledge of not just owning assets and managing them, But on the other side, institutional level, the actual infrastructure. And so these are really important conversations because we talk about a lot, success doesn't happen on an island. It's why we have self-storage income. We are stronger together. And together, we do better. I tell people that if my neighbor, my competing storage facility has 50% occupancy, that doesn't mean I'm winning. I'm not doing good if they're failing. In fact, it's the opposite. Them failing drags me down. But we also are in a landscape where the REITs are the biggest players. They have a competitive advantage due to technology. And that has changed the market wildly, but we didn't really see that effect until the last few years. It was something that we were talking about and preaching for over a decade previously. But I don't think people really could see it until once interest rates went up, we actually had to compete more, and they saw how that competitive advantage has changed. And that's kind of where I wanted to start. I want to start about having a discussion of this separation, how this competition in the marketplace, what we've seen with rates that is so different, why we see that. Why are these big REITs dropping rental rates and yet they're still actually growing? Their revenue's growing, even though it may not be huge, anything else, but why are they dropping rates 40%? And how are they still growing? What changed? And will this continue? And what does that mean for us? We're in Mississippi right now, and we're turning this storage facility around. Now, lots of people are out trying to buy facilities, small ones that range everywhere from $300,000 to $4 or $5 million. Now, they're worried about getting the money or having the financing. This is why we team up with Live Oak Bank, because they get this. They understand storage. In fact, we have them help us underwrite deals for our students and others because they are one of the best people in the industry when it comes to getting loans, especially small business loans. They can actually help the customers when they find the asset, understanding how much debt can I get? What's it going to look like? Not just because of the customer they're working with, but because of their knowledge base. That changes them from being a bank to being a real asset to the customer. We recommend Live Oak Bank to our students as well as others that are trying to get into the storage business. They have an in-depth knowledge of this asset class, so it's more than a bank. It's more than simply getting money. They're actually an asset and a partner to them, helping them go through all the things that they don't know and understand. Travis, why are we seeing this in certain marketplaces in certain areas where we can see this separation of in-place and street rates that is massive, and you have people that are dropping rates by 50%, but it's not hurting them? Why is that happening?
So I've got a few thoughts along these topics. And
Travis is about to get in trouble.
So first of all, Extra Space started it. Flat out.
They started it.
Extra Space started it.
It was
I was at a conference in Newport Beach in July, and nobody would say Extra Space started it. They would all talk around it and say, "Oh well, there's some large operators are Nope, Extra Space started it.
Who started it?
Extra Space.
Okay.
EXR ticker symbol, if you're curious. Now, Extra Space is a fantastic operator.
They are.
Extra Space has a crap load of resources, and Extra Space is very smart. Extra Space operates in a world that is separate from our independent self-storage operations. They have responsibilities to shareholders, unlike many of our responsibilities to shareholders. And so as we are coming off of the all-time highs, the greatest self-storage market that's ever been seen post-COVID, that was never going to be the new normal. We were always going to have to come off the mountain at some point to a real normal. And that's where we've been headed over the last couple of years. Extra Space has to report every quarter. CEO has to get on to the conference call and explain to their investors what's going on. Retail self-storage investors, they do a little homework, but they don't dig in a ton. What they know is, what's your occupancy? If your occupancy is high, you must be doing well. Well, if Extra Space's job to their shareholders is to keep their share price high, they've got to keep their occupancy high. And so when we're coming down off of this peak, occupancies for everybody in the industry, we're going to have to start coming down. But if you're a publicly traded company, that hurts your stock price. So if I give it away in the first month, I know if I'm Extra Space that I have the most sophisticated revenue management system probably in the industry, that yes, I'll get them in the door at 1990s prices for a 10 by 10. But because of my superior ability to rate manage those tenants, 45, 60 days later, their $60 unit that they came in at will be at 120. Now, that's how their revenue doesn't go down. There's a little blip, but not enough to upset a shareholder. And so their occupancy stays high. They take in all of those people because they have a massive website presence. They get the impression share because they're Extra Space or Public or Cube, pick a REIT. They get a large impression share, 20, 30% in a PPC environment. They bring those people in, they keep their occupancy up, they manage their rates after they get them in the door.
It was really a perfect storm that caused the outcome, the why. Interest rates went up, people stopped moving, there was less demand, the cost to maintain the properties with interest rates up or higher, less people searching online, more expensive to get the eyeballs online. They came up with a plan that if somebody went on to consumer shop online, they'd see a $50 10 by 20. Most consumers don't know enough about storage to really know what the price is. Seems pretty cheap. And so they get that conversion with that offer. They switched what we used to use as a promotion for rate. So rate becomes the promotion. Then they have the tech ability to track that customer individually. So tech is a part of it. The market was a part of it. Interest rates was a part of it. To do those in-place, rent increases for that customer very aggressively and uniquely. But then they had something else, kind of special sauce. Because if you look at their reviews, how are they absolutely just, 100% rent increases in 45, 60 days, right? Or whatever the time period is, huge rent increases. They dedicate a significant portion of that call center to handling those negative reviews and negotiating with those customers, which then changes those reviews, right? So there's a lot of pieces moving for them to do this, but at the end of the day, they answer to Wall Street investors who don't give a crap about the industry, don't give a crap about the company. They can get in and out. And it was a very effective, and still is a very effective tool, which has now led to legislative change in California. But that's what happened.
So the other piece I was reminded with regards to Extra Space specifically, and it was brought up during our Future of Self-Storage, was they had also made a very large acquisition at about that time, a couple of years ago. And they needed to get the occupancy up on this $655 million acquisition to justify, again, for their shareholders, that huge purchase. So there's lots of reasons why it happened. At the end of the day, we all were forced to compete with it.
Yeah, if you're flanked by Publix, right, what are you going to do? You got that much time on a 3.5-inch screen to get a customer to come to your store, and if it's 50 over there and 50 over there and 200 here.
And the customers don't care. They don't really know, but they also don't care. We had this portfolio. I was going in and actually having the discussions with the customers, and we were talking about the fact that the public storage down the street, which was at $200, is now at $60, and trying to explain they're going to jack your rate up 3 times, and you're going to have 180 whatever rate in literally the next 3 months. And so you may pay a little more today, but you won't get that steep, and it's still a discount. And it didn't matter. They literally were like, listen, it is what it is. It's $60 today. And I'm sure I'm not going to be there, right? They always are. And it's like, that's tomorrow's problem, and I'm getting the savings today, so I'm going to take it. So that's been effective and efficient, and it allows them to get market share and then worry about the revenue on the back end. The question that I have is, we've seen this, and a lot of people wondered, it's just a momentary blip, but is this now standard? Do you guys think that the REITs are going to change, or is it they've learned this works so well that we won't stop? They're never going to stop it. It's now the new standard mode of rate and revenue management, as opposed to being a competitive advantage when we have lower demand.
I think it's going to be here for a while. Unfortunately, I don't like it. It'll lead to more legislative change. It'll be state by state for that particular situation. But I do think it's here, and it doesn't matter, right? If you don't have competition of those publics, in all of my markets or most of my markets, it's a real problem. If you don't have it, it's not a real problem. But over time, right? What is the consumer going to think about our product, right? Are they going to be like, this is worse than used car salesman? That's a significant component. But again, the average lifetime of a CEO at a public company isn't forever, and the investors are less than that. And I think greed is going to drive that. And I don't think the analysts do a great job of reporting on it.
Travis?
So at my facilities, we call it the game. My team knows it as the game, and there's a separate playbook if your store is forced to play the game. I mean, the short answer to your question is, God, I hope not.
Yeah.
Because it's really kind of a crappy way to treat a customer. And it is not the reputation that we as an industry want to have. We have enough reputation issues with Hollywood. I mean, have you ever seen a happy story or a nice result from a documentary or a movie that originates at a storage facility?
Breaking Bad.
Breaking Bad had
like
a lot
that
of money.
Yeah, no, it wasn't about illegal activities at all.
That's right.
So we've got enough problems without inflicting them on ourselves. And everybody's got a boss, though, including publicly traded companies. And they have to answer to someone. And if it's working, they're not going to be inclined to fix it. And, even in that, when it happened in California, Extra Space specifically, they're like, okay, we'll stop. We're backing off from that. Well, Lance and I were on the phone, and in California, he's like, yeah, no, looks like they've got some, more normal rates that I would expect to see. And I'm sitting in Arizona, and guess what? Nope. Still playing the game because Arizona isn't pissed at Extra Space. California is. So it didn't give me the warmest and fuzziest that they were really dedicated to changing any of their methodologies.
So this leads us now to the next question, because we have seen this in our markets where even if the market isn't dominated by REITs, but you have, let's say, one of these, what we'll call bad actors. They're playing that game. They're hurting the market. But that one store then has that ripple effect against the market. You're trying to buy, you're looking at deals. We have to underwrite value, right? We were doing a development in Surprise. It's a very interesting conversation with banks to say, yeah, I know the rate dropped 50%, but it's not really. The in-place rate's actually totally different. And they're like, I don't care. That doesn't matter. What are you talking about? Like,
Website says it's all.
Yeah.
That's another area where the analysts are just clueless, right?
They're
Like
totally clueless.
they go online and say, oh, that must be the rate
And if you underwrite then storage in that market,
or rent.
all of a sudden the value is wildly different. And we see huge discrepancy now amongst different rates within the own market that we didn't quite used to see. When you're looking at markets, how do you think about this? What are some tactics that you guys are looking at to understand what we could call maybe a real rate or a true rate is, or if this is in that market, this is just the new normal, like rates are actually that low? I think that's going to be a huge question that everybody has. Is it just this one store? How much does that reflect in actual lower demand? Like, is it, oh no, there's actually just way less and less demand? How big of an impact is that? How can you, when looking at a market, when looking at a store, what are you looking for? What are signs? What are you trying to see to verify that rate and demand in the market? Because it used to just be occupancy, rates are high, there's demand, right? Where now occupancy's high, rates are down, but his rates aren't down. It leads to a lot of confusion.
So when I am looking at development sites, and self-storage units currently are not all that expensive right now, I would encourage you all to go rent units. Go through the entire process, sign the lease, pay the money, 25, 50, whatever. Stay there for 3 months. See when you get your rent increase, or see if you get a rent increase in that time. You will know factually what is going on in that market. Noah's product, Tract IQ, is doing a good job at, doing the best that is currently available in the industry at ballparking actual in-place rates of a market versus a traditional web scraping scenario. But my secret has always been go rent a unit. And then when you're open, keep it. I rent units from all of my competitors. That's how I know what they're doing. And guess what? As a tenant, I've got a gate code. I can go walk the property. I can go
Talk to the manager,
do whatever I want, and get all of the competitive analysis detailed that I want, because I'm a tenant there. I'm a paying customer. And so it sounds like a weird thing to do, but
I agree.
That it's a weird thing to do, or that
it's a weird thing to do.
Oh, wow. This won't be the first time that Lance and I disagree, I assure you on that. But it's something that is an easy way to see what your competitors are doing. You can get the timing of their rent increases, all of these kind of things you can figure out just by renting a cheap 5x5, throwing a lock on it, and never coming back. It's just kind of a handy little trick and inexpensive when you think about it. You're talking about a 7-figure property that, if you're $50 a month is too much for marketing research, think about what business you're in. This isn't your house.
There's macro reporting numbers from the public, obviously, that you can drill down and look at, and even some divisional information, right? So you could get to what sort of revenue is really coming, and you can get to that square footage, and it's really going to be like a Tract IQ, like Noah, to provide us this, because it's pretty difficult. If you ever get the opportunity, I have people that I'm so friendly with from a competitive perspective that if they call me and say, hey, what's your rates? But I just send them a management summary report, because at the end of the day, I don't care about your rates and your rents and all this stuff. If you get one question to ask of somebody that's going to share with you, just what are you depositing monthly in the bank? right? That cuts to the real chase of, and how many square feet do you have and what's your occupancy? You have a real world number. Now, with looking at large sets of data, Noah is going to be able to tag these properties that are the outliers that are playing the game, as Travis says it, and then look at what seems to be what's being collected and deposited in those spaces. And he's going to come up with a delta. And I don't know how accurate he'll be able to get, but it'll be better than we could get. Probably better, maybe even better than we get than renting spaces. But that's what we're going to need. And the challenge is, right, you're not going to be able to drill down in that REIT data to the store that you care about or the two stores that you care about. So you're still going to have a little bit of instinct involved, right?
Yeah. I think, along with that, so if I'm looking at a market, we have a bunch of stores, and let's say you see, oh, this rate's dropped. If I'm trying to figure out if there's really lower demand, I compare it to the other units. So if I'm looking at, let's say, Extra Space, whatnot, is it, or just the other competitors in the market, is it all the units? Have all the units just significantly dropped? Or is it they're trying to lease up their 10 by 20s, right? So is it all of a sudden 5 by 5s are going up? Like, is this an overall demand issue, or do they have demand in other units so they're not discounting them as much? Like, where are they at in that? And a lot of times you'll find that it's 2 unit sizes, and they're actually offsetting that with units that they have high demand, because as Lance got to with that, it's just how much are they making. So they're offsetting, oh, I have tons of demand in this unit. And even though we don't have, it's not like they have no demand or anything else, they have demand, but they still want to fill it up and maximize it. So they're going to discount it more on those units. They're softer. And that is really important when you're building or even buying, to say, which one of those units do we know in our underwriting we need to soften up that rate because they're trying to fill them up? And which one of the units do we not see that in the marketplace? In fact, it may be the opposite. And try to get to that total revenue number and understand that demand profile.
Yeah. The other thing I just remembered, if you're doing a ground up development and this is your first storage facility, please God, get a feasibility study.
Yeah.
You're going to need one anyways for your bank.
You're going to get one. So you might as well get it.
Read it
earlier.
Consume it, understand it. Don't just start building.
And don't have your builder or your architect provide you the demand study.
Yeah.
Correct.
A little bit of a conflict there.
And make sure it's someone that knows what they're doing.
I like to think I know what I'm doing, and I've done many feasibility studies. I still had one property in Marana get stepped on, and it was my fault. Didn't dig all the way in or as far as I could. I'll survive it. The property will survive, but it's taken a crap load more time than anybody wanted it to. And my new neighbor across the street, it's going to be a crappy 2 years for everybody.
Yep.
I feel good that my debt is less than his. That allows me to sleep at night. But you can do all the homework you can. You can come to these events. You can go all the events until you've built a few storage facilities. Absolutely find a third party to give you their 2 cents on if it is a good project or not, and if it looks feasible to them. Better to spend $10,000 now than $4 million later and find out you were wrong.
Well, and you got to remember, guys, you have 100 to 600 products. You're trying to understand who your customers are, who you're competing with. I see a lot of times either thought process or feasibility that is just simply, there's a lot of occupancy and rates look good, so we'll build a storage unit. And what unit are you building? Well, we're just doing whatever the architect could get to maximize the space. Your underwriting is going to be wildly off, and you're going to make huge mistakes because you're not building to the market. You're just building whatever space the builder and the architect could fit in and maximize. So you're doing your business plan predicated on the space, not the customers, not the market. You don't need the exact same amount of every single unit. That's not what the market's asking for. That's not how you maximize prices. And you also need to understand that those change. So, historical. Are they just soft right now? Is it just one size? Dig down. Really get to know. Go rent other units. Talk to the competitors. Look at the neighborhoods around you, right? It's not a lot of units. You got doors-wise, we're talking 100 to 600, right? So understand where that 100 to 600 people are coming from, what they want, and what they're going to pay. That's really, really important. Now, the next thing that I want to go over here, I had somebody send this to me. It might have been you. I can't remember which. But I'm trying to find it here. It was a list of fees. So was that you that gave that to me? Or was
no, there's a Canadian in here.
Right there.
They are right
Canadian.
there, front and center.
Did you give that to us? That was the list fee? Okay, see, there we go. I knew you were not good looking enough to it have been you.
What's he saying about you? Look at that.
Yep. So what we saw here and like what you were showing me was that you have the rental rate. Okay, so you have a rental rate, but then once you go to checkout, there's all these fees. So then when you get done and you have to pay, the actual rate is nothing.
It's better than that. That invoice is the monthly.
Yeah.
That isn't on checkout.
Monthly.
That's every month.
It's exactly right. This isn't a sign up fee. No. These are monthly fees. So your monthly rate is not what you signed up for, right? This reminds me a lot of hotels, right? You ever go rent a hotel for $100 a night and then it's $300 somehow when you get like charged? Obviously that's an exaggeration, but it's $20 more. That's a 20% increase on what you're paying. Do you see more companies start to get more creative about how they're getting those rates up as opposed to just jacking up rates? Honestly, that was the first time that I'd ever seen it to that extent, right? That there are so many monthly fees. Have you guys seen this in other markets and this was a Canadian facility, correct? Yeah. In BC? Okay.
Yeah, in Vancouver Island. Yeah, I've seen aggressive fees over the times. I haven't seen a reoccurring invoice like that ever in my life, honest. But I have seen, auction fees, advertisement fees, lot cut fees that I would say are abusive. And, that does happen. This approach that I looked at the other night, it kind of blew my mind because how many were there? 5 or 6?
Yeah, like 6
things associated with your monthly bill. And guess what? Canada's even got another trick. Forget about monthly. They bill every 4 weeks. So it's a 28-day schedule, which must be really confusing for the customer because when is the rent due? But they do that a lot in Canada. But I was quite surprised. And if you become California, be careful because our laws are going to be really strict on that.
Have you seen that, Travis, before?
Oh, there are some operators that love them some fees.
Yeah.
And I don't usually see it on the monthly recurring basis like that was. The thing I couldn't get over, if I remember correctly, was that invoice was $373 for a 10 by 10. I was like,
that's Canadian. That's Canadian money too,
Oh, okay, that makes a whole lot more.
Oh, so it was $20. No,
yeah, I was like, oh my God, this is no.
That's like the Alaska money.
Yeah. So there are definitely operators that love them some fees, and I'm not a believer in it, but to me that is a business decision.
That's a business decision, and I can tell you just culturally how I've always been in business. I was the largest RV storage provider, I think in the country at one point, but certainly in California. I had a lot. And I would build these properties and everybody go, why are you doing all this stuff? I would put in air systems and power wash systems and dump stations and wash racks and 50 amp services where if they wanted to work on their RV, they could under a cover. And I'd put in potable water and, everything, propane if I could put it at that store. And I wouldn't charge for any of it. Right. Well, propane I would, but there would be no charge for any of it. And everybody goes, why are you doing that? Because I said, when somebody gets a rent increase and they decide to leave, because if it's a nice RV, they can go start it and drive off, right? It's not like unloading a 10 by 20. They're going to start shopping. And when they go to the other properties and say, where's the ice machine? Where's the air machine? Where's the wash rack? Where's the dump station? Right? Where are all these things? Because they may just assume they're there. They're not going to be there. And if they are there, there's going to be a bunch of charges. So that my philosophy is that's just me, right? Like you say, that's a business practice. I'm against it.
Okay, guys. So we're seeing different things, obviously, and changes in behaviors when it comes to rental rates, in place, out place, fees that are being charged that are new, right? We haven't really seen this before. Let's talk about, we have a confluence of, for the first time since, after 2008, we've only ever seen increased really demand. It's just been year after year after year after year, increased demand, lack of supply due to the Great Recession, which just exacerbated that. That created facilities that were always full. It skewed really after 2018 reality, obviously, where everything was full all the time. We, for the first time, really came back into a normal. And this is really important to remember. Like when we were starting out doing 85% occupancy was like normal. That wasn't crazy. During the Great Recession, you had a couple of years of downturn rent, but we're talking like 7%. We had 1 year that was over 20%. And just 1 year after, interest rates went up because of a lot of what we were talking about earlier today. This returned to normal, though, as a lot of people scared. And I'm like, we're still at 90% occupancy, but there had to be adjustment in expectations and reality. Moving forward, as we move out, we're now on another part of the cycle, right? Interest rates start coming down. I saw it today, 30-year mortgage was at 5.9 today. And so we start to see the market will ease up. Housing transactions are lower than they were in 2008. They're below that. So we've kind of bottomed out here and we kind of hit the hard spot. We're still at 90% occupancy. We're, the industry, we're the lowest defaulting by far. I mean, any other one, you look, the next one that even comes closest to self-storage is like 3 times higher. And then you get in past that and it's wild. What does a new normal look like in self-storage? We went from before institutional, as I like to think of it, 2008, to teenage years, institutions pouring in, and institutionalized private equity, people talking about it on podcasts, writing books, idiots. And then we get to a point where it's like, okay, party's calming down, moving in now. We kind of believe the worst of it, obviously, and then new normal. What does that new normal look like? Our storage facilities, what has changed in how we build, how we operate, and what the consumers expect? We have competitive landscape, which changes behaviors of operators. What does the new normal look like?
So I spend all of my time in tech. I'm not doing a lot of development. Actually, I'm doing one in Texas right now. I forgot about that. But I'm not obsessed in that space right now. I would spitball and say I'd probably be underwriting a 2.5 year lease up to an occupancy of maybe 87%, which may be even a couple points aggressive. And I'd want to make sure that the deal pencils at those sort of numbers. And I feel like I'm, pretty good at trying to figure out the market. And I think I'm pretty good at getting the rentals if the market's there. But, I took a lot of heat in this industry for calling it out as a commodity, right? We are a commodity. We're a need-based product that's interchangeable in the consumer's mind. You can't create demand for commodities. So you have to make sure the demand is within the market, and then you have to be better at capturing it than your competition. But I feel like I could do that.
So where we're coming from, like I mentioned before, was not normal. And so I think what is going to be normal again was my first normal. That was 85% occupancy, a 3-year lease up, depending on size of the facility, but a good safe 3-year lease up, and an expected 5 to 6% return on acquisition. So I'm saying cap rate.
Also, we left out one key thing there, right? If I'm building a 200,000 square foot rentable facility, that opinion's going to change. My sweet spot's always been around 80,000 net rentable. So when I throw those numbers out there, that's kind of what I'm thinking about.
Yeah, and then I think the other thing, and we talked about it on the panel this morning, is normal is going to be the continued adoption of technology and implementation of it in the self-storage facility and the operations of the self-storage facility. That is the customer expectation of all of the businesses that they interact with. And that will be the table stakes expectation moving forward.
And you're obviously, we're talking about development, right? To even throw those numbers out, we're not talking about acquisition, obviously, and so that's a different discussion, right? Acquisition versus development. What would you do?
Well, now I want to hit on something though that's really important that Travis just said. Customer expectation. This is something that always frustrated me in self-storage. Was the self-storage owners and operators acted like they were making the decisions, right? No, we're not going to do a website. We're not going to do these things.
You still have that right.
You still have that, right? Like in storage.
Give it a whirl, see how it works out.
Yeah. And what we're talking, when we talk about change, everybody, this is driven on what we're seeing that the customers are doing and working. That's why Extra Space and Public Storage, that's why they're doing it. Is it worked. They could get the customers to do it. Doesn't mean necessarily it's right, but they're going, hey, the customer's going to do that, right? So this is demand driven by not only just demand simply of the products, but also demand of how you interface with the business. One click changed the game. It took attention span between social media, Amazon, to nothing. And as I always like to tell vendors and people in my company, nobody wants to go sit down with you and do a lease. Nobody wants to spend 15 minutes going through a lease. I don't care if you think it's important. I don't care if you like it. Nobody wants that. Nobody. They don't care. They don't want to get to know
And if they really, 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 really want it, you probably don't want them as a customer.
Yep.
You might be talking to your next lawsuit.
Yep. So when we look at this is why these things we're talking about is so important, because we're trying to understand the customers. And if they change, this isn't about even being competitive. It's just how you get and achieve those customers. One click, social media, how we interface has completely changed. All of us. I'm shocked about how we think the business should operate, but then we don't participate as customers. Right? Like, no, I think we should do this. We don't need a website or anything. And then you go and you actively consume differently than you run your business. And I think getting back to a lot of these first principles is really important. The problem is technology sounds complicated. And we think, I don't know and understand those things, so I'm not going to do it. Yet you're interfacing with it. Right? You see the difference? Like, oh no, there's all this stuff, pay-per-click and websites. I don't want to understand any of those things yet. I buy 80% of everything from Amazon. So this is one of the big reasons why store local came up. There's an emphasis on technology, and then that rolled into tenant. And we've always been really, really striving to update and bring that industry and the technology as we talk about it is the way we interface with the customer. This is your manager, this is the portal, this is everything, right? This interfacing, though, and the ability, I want to make sure before we jump in this discussion, you don't need to know. You don't need to know the code. You don't need to know the back-end data. You don't need to know, right? You need to know what the customer wants, who provides it, so then you can just do it for the customer. And then what you need to focus in is how your operations within the business work within that. This is leading a big change into how we view smaller facilities. If you were going to acquire a small storage facility 15 years ago, right? Very different in how you figure out how to operate it. I mean, we would hire somebody to go on site if we could, and you had a part-time manager. But it's changing the way the industry looks at the big bomber facilities, the mid-size, the small facilities, that for virtually all institutional capital, there was a line. We're not going anywhere below this. It doesn't make sense. We can't make it work. First of all, scale. You can't operate them all. Margins are squeezed with volume. Tech is beginning to change this. I want to walk through first why the advances in technology that we've seen, everything from your operating system, like the property management system, Lance, that I want you to talk about, automation and including the hardware of the asset, keyless technology into your property management, which then can tie into the customer acquisition, how that is changing how we operate and view viable facilities. This is really important because are we, as institutional capital, are we going to consolidate downstream? Which 6 years ago, I don't think anybody, like that wasn't something people thought. Never, I mean, extra space they spent. You mentioned the acquisition. Well, the size of the acquisition, and then talk about the portfolio, Travis, real quick about that acquisition so we can understand it.
So that was a $655 million acquisition of 119 properties approximately in the Midwest.
Remote managed.
And that was an original remote manager that had been operating remotely
His whole career
and 20 plus years. You know, it was mentioned before that he had the little guys in the pickup trucks, and that was his team. He didn't have managers. And he was very successful in his exit. And he's now a United States congressman.
What were the size of those assets?
They were decent size. Like they weren't 10,000, 20,000.
Yeah, these weren't 20,000 footers. These were 50, 60,000 square foot.
And I think that the REIT really believed that they were going to acquire this asset and learn some incredibly secret sauce in how to run remote managed properties, and they were going to run a different brand. And it was an empty shirt. I saw inside the company several times, there really wasn't any tech behind the scenes. It was, cubicles in the call center with Thomas guides like up on the wall pages trying to answer questions. I mean, it was and sticky pads and writing notes down. And I mean, it just wasn't there. And I don't think that was a good buy for them because one, they weren't really acquiring something that was special. Two, they probably weren't willing to be creative and embrace that space. I think public's actually been more creative in embracing that space than they have now on, call it, remote managed properties.
So now, though, we see them being aggressive, trying to get this technology. They're trying to change their operating systems, remote management, right? This has opened up doors to like a lot of it has been to a rush over the last 5 years, a mad rush. Right?
There's thousands of stores operating like this today.
Yeah, thousands. And this has opened the doors, frankly, for a lot of you being in here. The idea of operating, small facilities and building a portfolio out of it, that was a very different thing, out of state, small facilities. And I know because we did it.
I just want to drive back to that because our industry sometimes is so bad. Like, you applaud all yourselves for being here because, it's all about information seriously. And getting information. We would talk early on about, remote managed, or they used to call it managerless, which was crazy because there's no such thing, but remote managed properties, right? And even the public companies, the CEOs, you'd be with them at a conference, and they'd be like, that'll only work in New York City or this or that. Well, the company that proved it in rural markets.
Yeah.
Right? It was proved in rural markets. And yet the public companies were completely unaware of it.
And two, the markets they were in were focused on, right? They missed a lot of that. They're bigger facilities, first tier markets, right? Lots of revenue to justify managers, but that's not the case in rural markets. A huge portion, humongous portion, as far as number of facilities, is out of REITs. They're in small towns everywhere, right? And the remote technology allows you to be in another state and operate it at a level, and I think this is the key. The technology allows you to operate a small rural facility like you can today with a bigger one. This is the other side of this coin where we talk about technology and REITs dropping rates and they have a revenue management system. It also dropped barriers of entry and allowed this technology that they kept hidden and secret, right? That was extra space in the formula coming in, to a point where we can have like Tenant and others, as they give that technology, build it and give that technology to the market, to take that same formula and use it in markets and asset classes that technology like that, they weren't doing anything, right? And there wasn't a thought. Like I said, the public, they weren't even thinking about that. And that allows you here to have tremendous power, all of us, to be in markets and operate better and go to these different markets. Is this going to be a trend, not only that we see, but are we going to, when it was hot, obviously consolidation moved into smaller markets just because of viability. Do you guys see the market continuing to consolidate off into third, fourth, fifth tier markets, smaller sized assets, not just 60,000 plus by institutional capital? We've seen huge amounts of private equity and venture capital, everything trying to pour in to do different things. Was that a flash in the pan? Was that just because money was free, consolidation went out? Or is this a trend that we will now see?
Public storage wants to own the world, first of all. And public storage has a unique advantage over everybody on the planet. There are people with business plans of 5, 10, 30, 100, 300-year business plans. For real. Public storage has a business plan called forever. That's their plan, and they mean it, and they want to own everything, right? So I do think we're a commodity, and I do think there will be more consolidation, and I do think it will be tougher to compete. And one of your questions early on in that conversation was, what are we trying to do? Because when we talk about tech and data, it's all so confusing, and it just sounds like a nightmare, and if I could break it down for what we're trying to do, we're trying to take you to a movie. And in the movie, there's 3 screens that you can watch. You can go into 3 theaters. The first theater and the first set of screens are all around the consumer and the consumer experience, and going out and finding, attracting, and converting that customer to becoming a tenant of your property. That's one movie. It's complex, there's a lot there, but just take that movie. Then you go into the next movie, part 2, or this sequel or whatever, and now you have that tenant, and how do you manage them while they are with you, and how do you handle all of, whether it's your rent increases or your reputation management or reviews or keeping them happy and all of those things. That's the second movie. The third movie is the one that you really want to watch over and over and over again. And that's this giant wall of usable data and information where every single day you can make a decision on how you want to optimize your business. And it's all there, and it's all dynamic, and the cause and effect of things you do, and you experiment with it all the time, and you make mistakes, and you back up. You go a little, you didn't go far enough, you go a little further forward, and you just keep tuning your business. And that's where you can beat a lot of people, but you have to work, right?
You're a boring first date.
That's a really good movie. I'm sorry.
And actually, that's
a good movie.
Those are the movies I want to go to. So, Travis, do you see this ability and the abilities that we're getting on, not just obviously for all of us here, but even on an institutional level, driving down into smaller markets, smaller assets? Was it just a huge overreach for 4 years and wasted capital, and that took a pause, or will this continue?
So I would say that there are, 30, 35,000 independently owned self-storage facilities in the country, and a big chunk of them are in those secondary, tertiary markets. And they're going to need somebody to do that for them. I don't think that the REITs and private equity necessarily have the appetite to go and roll up those kind of deals. I think if someone were to, and go to a private equity company with the right story and say, look at what I've rolled up, and you don't hate tertiary markets as much anymore, do you? Because the number's bigger, then you'd get some traction. Tertiary markets have small facilities and a crap load of them, and somebody would have to go into a market, and there's this little town in Montana that has more self-storage than I've ever seen in my life, and I don't understand the supply and demand metrics associated with it. But by God, there's a crap load of 20-unit separate facilities there. Somebody went and rolled those up. Somebody bigger might talk to you then, but they're not going to go roll those up.
The cost of transaction, they're too small. The cost of transaction is so big for the publicly traded. So it's not that they don't necessarily want them, but it costs so much and expenses everything to do them. So
it's not worth it for them. They want somebody. It's almost like a C of O deal. Like, you go develop it, you go build it, you deal with the headache, and then we'll pay you a little big on top.
You build the management, get all the tenants, all the systems, processes to run these 100 small facilities, and then we'll come write you a big check to take it over.
Yeah, they don't have the tools to run that stuff, just like the Extra Space experiment with Storage Express. They thought they would just adapt all this brain trust and tools, and they found out there was nothing there. And then they don't have the energy to dive in and say, okay, how do we optimize this? My feeling is when interest rates come down, we'll see that portfolio on the market personally.
So when we're thinking about this, the one thing that I want to stress here is the opportunity. Right now, we are in a place in the market that is so wildly different. Getting started or even scaling a business, you have tools that the REITs had, right? I mean, go back just 15 years ago and you have tools that you can use the REITs didn't have. You have institutional level technology, institutional level services that you can deploy in areas that don't have it. And there's appetite upstream that there didn't used to be. So we have huge private equity. Private equity is massive in the space now, which is a middle layer between REITs. So now there's appetite all the way up the ladder. That makes it fluid for you to go in, buy, build, create a portfolio that could be huge, hundreds of millions of dollars.
It's the little fish that gets eaten by the bigger fish, that gets eaten by the bigger fish, that gets eaten by the shark.
That didn't used to happen. You had a shark and you had a little fish.
That's why I want to be a killer whale.
But you didn't have a fluid market. Cap rates couldn't compress. You didn't have capital that could move through it. You didn't have, buying a facility, turn around and selling it. That was a gamble. It may still be worth a 10 cap and you may not have a buyer, right? That's not true. The capital level and the players in the industry now fluid, but more importantly, you have all the tools that you could ever need to do it. There's so many people that have large portfolios and people in this room that it's the optimization that you could do on your 4 or 5 stores through net income improvement and getting it to a point doing simple basic things that now private equity wants to pay you a premium for. This is an incredible opportunity. We didn't have the tools. We didn't have the capital, as in there was no mid-sized fish or anything else like that. You wanted to sell a REIT, you had to be in a first-tier market with a big, huge facility. So the wealth creation comes with an exit. It comes with the tools that you need and the ability to scale. This happened in a very short period of time. 2018 on was just a gold rush to supply the storage industry with tools and everything else. And we've had this pause due to interest rates. The pause will change again. And more people will flood in and have the tools, and they'll have the ability to sell up, do roll-ups, and move in, and that'll attract capital, right? We're in a moment of time that is very special. It is an in-between period for this industry. It is a pause of mass consolidation, everything that's been going on. It gets, obviously, us excited. We're investing in the future, and it gets us excited about all of you. Now, with that said, I am over time, so we are going to end it here. Thank you, everybody. We appreciate the time.
Thank you.
Let's show them some love and appreciation.